In this section, we will dive into some important facts about interest-only and payment option mortgages. Whether a customer is buying a house or refinancing his or her mortgage, having a thorough understanding of this information can help the loan originator decide if an interest-only mortgage or a payment option mortgage is right for them. These mortgages can be very complicated. Borrowers often do not understand mortgage terminology and loan products. If the loan originator does not understand how they work, it opens the door for misinformation and poor advice to be given to customers. Interest-only mortgages differ from traditional mortgages in that traditional mortgages require that each month a borrower pay back some of the money he or she borrowed, which is the principal, plus the interest on that money. The principal owed on the mortgage decreases over the term of the loan. In contrast, an interest-only payment plan allows a borrower to pay only the interest for a specified number of years. After that, he or she must repay both the principal and the interest. Most mortgages that offer an interest-only payment plan have adjustable interest rates, meaning that the interest rate and monthly payment will change over the term of the loan. The changes may be as often as once a month or as seldom as every 3 to 5 years, depending on the terms of the loan. Let's take a look at an example. A 5/1 ARM has a fixed interest rate for the first 5 years. After that, the rate can change once a year during the rest of the year. The rate being able to change once a year is the 1 in the 5/1. The interest-only payment period is typically between 3 and 10 years. After that, the monthly payment will increase even if interest rates stay the same because a borrower must pay back the principal as well as the interest. Let's take a look at an example. If a borrower takes out a $200,000 30-year mortgage loan with a 5-year interest-only payment period, he or she pays only interest for the first 5 years and then must pay both the principal and the interest over the next 25 years. Because he or she begins to pay back the principal, the payments increase after year 5, even if the rate stays the same. Keep in mind that the longer the interest-only period, the higher the monthly payments will be after the interest-only period ends. Then there are payment option ARMs. A payment option ARM is an adjustable rate mortgage that allows a borrower to choose among several payment options each month. This loan product, like many of the past subprime mortgage products, were not meant for everyone, yet somehow made its way into the mainstream, becoming a big contributor to the downfall of the market. Some lenders actually use the negative amortized payment, oftentimes referred to as the minimum payment, to qualify borrowers for loans they should never have received. The options typically include the following: a traditional payment of principal and interest, which reduces the amount a borrower owes on his or her mortgage. These payments are based on a set loan term, such as 15, 30, or a 40-year payment schedule. The options also typically included an interest-only payment that pays interest but does not reduce the principal amount owed on the mortgage while the borrower is making this type of payment. Finally, the options also typically included a minimum or limited payment that may be less than the amount of interest due that month and may not reduce the amount owed on the mortgage. If a borrower chooses this option, the amount of any interest not paid will be added to the principal of the loan, increasing the amount owed in future monthly payments and increasing the amount of interest he or she will pay over the life of the loan. In addition, if a borrower pays only the minimum payment in the last few years of the loan, he or she may owe a larger payment at the end of the loan term called a balloon payment. The interest rate on a payment option ARM is typically very low for the first few months, for example, 2% for the first 1 to 3 months. After that, the interest rate usually rises to a rate closer to that of other mortgage loans. The payments during the first year are based on the initial low rate, meaning that if a borrower only makes the minimum payment each month, it will not reduce the amount owed and it will not cover the interest due. The unpaid interest is added to the amount owed on the mortgage and the loan balance increases. This is called negative amortization. This means that even after making many payments, a borrower could owe more than he or she did at the beginning of the loan. Also, as interest rates go up, a borrower's payment is likely to go up as well. Payment option ARMs have a built-in recalculation period, usually every 5 years. At this point, the payment will be recalculated, lenders use the term recast, based on the remaining term of the loan. If a borrower has a 30-year loan and she or he is at the end of year 5, the payment will be recalculated for the remaining 25 years. If his or her loan balance has increased because he or she has made only minimum payments, or if interest rates have risen faster than his or her payments, the payments will increase each time the loan is recast. At each recast, the new minimum payment will be a fully amortizing payment, and any payment cap will not apply. This means that his or her monthly payment can increase a significant amount at each recast. In the event negative amortization causes a loan balance to reach a present limit, 110% to 125%, a lender can recast the loan to initiate amortization before a rescheduled recast period. Lenders may recalculate a borrower's loan payments before the recast period if the amount of principal he or she owes grows beyond a set limit, say 110% or 125% of the original loan amount.